Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by MFS Investment Management, backed by 40 years of essential fixed income. Markets change, but the role fixed income plays shouldn't. That's why we stay true to our traditional approach, essential fixed income. Find out more at mfs.com/fixed income. This week on the podcast, our analyst takes on Coca Cola and Cisco results. Christine Benz suggests 3 strategies for generating cash flow in retirement. Travis Miller highlights 3 utilities for income investors. Jon Hale talks about the growth of sustainable investing. Mark Cash gives his take on Dell stock. And Alex Bryan shares a low-cost ETF with a focus on strong businesses. Let's get started. First, results from Coca Cola and Cisco.
Coca-Cola's full-year results largely met our expectations, with sales of $31.9 billion, adjusted operating margin close to 31%, driven by its bottler refranchising, and adjusted earnings per share of $2.08, all near our estimates. We remain confident that the firm will be able to leverage its brand strength and pricing power, which underscore our wide moat rating, to drive mid-single-digit organic sales growth over our 10-year forecast. Organic sales for the year grew 5% and included a 2% contribution from price and mix, lifted by the firm's continued focus on higher value packaging formats. We expect contributions from price and mix to average around 2% over our forecast. In North America, price and mix strengthened 2% in the fourth quarter, a significant improvement from the flat to negative performance in the prior 3 quarters, which helped offset the cost pressures that have been weighing on firms across the space. However, unit case volumes fell 1% due to efforts to improve pricing for sparkling soft drinks, downsize juice packaging, and de-emphasize lower-margin tea products. We continue to appreciate Coca-Cola's efforts to innovate within its portfolio and expect new product launches and line extensions to help it adapt to evolving consumer tastes, ensuring its share and pricing power remain intact over the long run.
Cisco reported second quarter earnings last night with results that were in line with their expectations as the company grew 5% year over year. As we look forward, we believe Cisco will be able to sustain its growth rate, and we have raised our fair value to $49 per share from $46. We like that Cisco is gaining momentum in high-growth areas like software-defined networking and security for cloud-based environments. We think that Cisco is becoming less reliant on a hardware refresh cycle as it grows its software-based sales and recurring revenue streams. In addition, Cisco announced $6.5 billion of return to shareholders in the quarter through buybacks and dividends. The company also announced a 6% increase to its dividend, raising the yield to 3%, and still has $24 billion to return to shareholders.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Next, 3 strategies for generating cash flow in retirement.
Hi, I'm Christine Benz from Morningstar.com. There are 3 key ways to extracting cash flow from your portfolio in retirement. Understanding the pros and cons of each approach is an essential first step in finding the right method for you. The most obvious and intuitive method for generating cash flow from a portfolio is to rely on income-producing securities to supply your living expenses. That can mean focusing on dividend-paying stocks, bonds, and hybrid securities like convertible bonds or preferred stocks. There are a couple of big attractions to the income-centric approach. Relying on income from your portfolio is familiar. It's similar to the paycheck you had when you were employed. Another big attraction to an income-centric approach is that relying on income for living expenses helps ensure that you won't prematurely deplete your principal. This is a big reason income-centric strategies tend to be popular among people who want to leave a legacy. Income strategies may also be attractive during difficult market environments. As long as the portfolio is supplying the income you need, you may not care if your portfolio is moving up, down, or sideways. Finally, yields have come up significantly over the past few years. That means that retirees don't have to stretch for income as they did following the financial crisis. On the other hand, yields aren't always guaranteed. Investors saw that during the financial crisis, when many banks, which had historically been a reliable source of income, slashed their dividends. Similarly, investors who had been relying on cash and bond funds for income had to make do on ever smaller yields during the recovery. In addition, yield-centric portfolios may not always be the best diversified, and they can court risk. Lower quality bonds have historically had attractive yields, but their performance often moves in sympathy with stocks. On the stock side, dividend-centric stock portfolios often short-shrift higher growth companies, which prefer to reinvest in their businesses rather than pay out cash to shareholders. An alternative method is to build a well-diversified portfolio, reinvest all income distributions, and use rebalancing to shake out the needed cash flows. The big advantage of this strategy is that because it's not focused on current income generation, the portfolio can be better diversified across security types and sectors. Another attraction to this approach is that not relying on current income means a retiree can withdraw a fixed dollar amount annually, which helps ensure a steady standard of living. Finally, the process of rebalancing, periodically selling appreciated securities to meet cash flows, can reduce risk and enable a retiree to stick with his or her desired asset allocation mix. The big drawback to relying on rebalancing to meet living expenses is that there may be years when there's nothing to rebalance. That was the case in 2018 when both stocks and bonds had a weak year. And in contrast with an income-centric approach, a pure total return approach doesn't have a built-in safeguard against running out of money. A retiree's withdrawals need to be sustainable for a total return strategy to work. The last method combines income and total return together. With this strategy, a retiree can use income distributions for spending money and turn to rebalancing for additional cash flow needs. On the plus side, those income distributions can provide some peace of mind because they ensure that some cash is always coming in the door, regardless of market climate. One other attraction to this approach is that a retiree isn't actively reaching for yield, so the portfolio can be better diversified. I also like this approach allows for ongoing rebalancing, which can help reduce a portfolio's risk level. For example, a retiree using rebalancing would likely have been selling stocks after 2017's good market performance, which would help reduce risk coming into 2018. Like the pure total return approach, this hybrid approach won't ensure that a retiree won't run out of money. And spending current income can be a drawback in that there may be times when it would be better to reinvest instead. And this type of hybrid strategy can also be more complicated to implement than either an income-centric or a pure total return approach. All of these strategies have the potential to run into problems at various points in time, which is one reason why I like using a cash bucket alongside whatever cash flow generating strategy you decide to employ. Thanks for watching. I'm Christine Benz from Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, Travis Miller highlights 3 utilities for income investors.
Most U.S. utilities these days are in good financial health with good dividend growth prospects and well-covered dividends. But we're going to highlight 3 that we think are particularly good for income investors. We think Edison International offers investors both upside to our $66 per share fair value estimate, 4.5% yield, and also 6% dividend growth. It's been caught up in some of the wildfire concerns in California, but we don't think that risk is nearly at the level of its northern neighbor, PG&E, which pays no dividend. The second name we like is Dominion Energy. It's been growing its dividend upwards of 9%. We don't think that it will grow that fast in the future, but it is our only wide moat stock, and we do think it has significant upside on the stock price. And the third, Sempra Energy, also another California utility, caught up in some of the California wildfire concerns. But in this case, California is only half of its business. We think it's going to invest upwards of $5 billion a year. Even though it trades at a 3% dividend yield, we think it can grow 9% for the next few years and possibly even as much as 11% in 2021 and beyond.
This podcast is brought to you by MFS Investment Management, backed by 40 years of essential fixed income. Your fixed income strategies should aim to deliver the essentials for your clients: income, diversification, and risk management. Find out more at mfs.com/fixed income. Next, Jon Hale talks about the growth of sustainable investing.
For Morningstar, I'm Jeremy Glazer. We recently released the Sustainable Fund Landscape Report. I'm here with its author, Jon Hale. He's our Director of Sustainable Investing Research to go over some of the big key takeaways. Jon, thanks for joining me.
Good to be here.
So your first takeaway was that the universe of sustainable funds, of ESG-focused funds, really continues to expand at a rapid clip.
Yeah, in fact, this year we had 351
open-end and ETFs in the study. Last year, only 235. So quite an increase in just 1 year.
Your second point is really around flows. Are people interested in these funds, or are they just launching, or are they actually attracting investment assets?
It was very interesting. You know, this year, despite market headwinds that actually produced a bad year for net flows for most long-term funds in the U.S., for the third year in a row, sustainable funds had record flows, about $5.5 billion into this group of funds that we label as sustainable. The third year in a row, as I said, that was a record. And just to put it into context, I went back for the 10 years following the financial crisis. The first 4 years of that, so that'd be 2009 to 12, the average inflow per year for these funds was about $135 million. Very, very small, tiny. Now, for the past 6 years, the average flow has been about $4.5 billion and $5.5 billion just in the last year. So still not huge compared, obviously, to the overall fund universe, but an immense amount of growth during this decade. The
third point is around active passive, always a hot topic. ETFs are taking a bigger share here. Why are those starting to catch on in this world?
Well, we've seen a lot of issuance of new ETFs in the past 3 years. And so it is now possible for sustainable investors to develop a market-based portfolio using ETFs or other passive instruments that are open-end as well. You know, I think it's something that clearly follows the trend towards ETFs. So ETF providers think this is an area that where flows will materialize, and they've started to do that just in the last year. Yeah.
As this universe begins to expand, are you seeing kind of a breakdown of where funds are landing in terms of the strategy that they're using to kind of hit these ESG factors? What's that looking like?
Yeah, so all ESG sustainable funds are not alike. I identify in the report 4 different types, actually, of funds that you can tell based on both their holdings, how they do in the Morningstar sustainability rating, but also just what they say in their prospectus. There's a lot of funds out there, previously launched open-end funds that have added ESG to their perspective, indicating to me that they are now considering ESG as part of their process, otherwise remains unchanged. So we have a lot of those kinds of funds now. The sort of more standard approach to ESG, I call ESG integration, which are funds that really try to use ESG in a more comprehensive and holistic way than the consideration funds. And they also do a lot of active ownership, engaging with companies that they own. Then thirdly, there's impact funds. That's a new trend as well. Funds that, in addition to wanting to deliver financial return, they want to deliver some sort of discernible, measurable impact, societal impact, environmental impact to their investors, and they're calling themselves impact funds, and they're really focusing on how they convey that idea to their investors. And then finally, funds that have been around for a long time, sustainable sector funds, I call them, are focused really on those areas of the economy and those companies that are involved in the sort of transition to a low-carbon green economy.
Finally, what does performance look like?
Performance was good last year, very good. In fact, if you look at, on average, funds in the universe, so, half the funds would finish in the top half of their Morningstar category. Sustainable funds, which can be found now in dozens of different Morningstar categories, 63% of sustainable funds finished in the top half of their Morningstar categories last year. Only 18% finished in the bottom quartile. So very good performance last year, really across the board. All these different types of funds did pretty well. Equity funds did especially well. They tended to hold up well during the difficult market environment.
Jon, thank you.
My pleasure.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Now, Mark Cash gives his take on Dell stock.
We recently initiated coverage of Dell Technologies with a fair value estimate of $56 per share, and we view this no-moat, stable moat trend name as slightly undervalued. However, We assigned a very high uncertainty rating to the company due to substantial debt load and concentrated ownership profile. Made up of 8 brands, including an 81% ownership stake in their remote VMware, Dell Technologies offers products that cover the entire IT infrastructure ecosystem. We expect a gradual slowdown in the PC market to force Dell Technologies to rely on growth elsewhere. In our view, the company is well positioned to execute on rapidly growing trends like flash-based storage, hyperconverged infrastructure, and software-defined networking. We believe Dell Technologies has substantial cross-selling and upselling opportunities across its brands, which could increase switching costs over time. In the marketplace, we are seeing Dell EMC hardware paired with VMware software alongside solutions like Dell Technologies' cloud-based software platforms being offered together. We are fans of these collaborative efforts, and we expect this trend to continue. Lastly, investors should understand that Dell Technologies has a sizable debt balance. While we believe the company should cover its immediate debts, there is potential the company misses out on the next big thing due to its obligations. Also, shareholders are largely beholden to Michael Dell's strategic vision, and past Dell deals may not have always been for the public shareholders' best interest. With that said, we believe the company has a sound strategy for the changing IT infrastructure landscape, and that Dell Technologies will be a key cog in the world of hybrid cloud IT ecosystems.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
And finally, Alex Bryan shares a low-cost ETF with a focus on strong businesses.
iShares Edge MSCI USA Quality Factor ETF is a compelling, low-cost fund that should offer better risk-adjusted performance in the market over the long term. This silver-rated strategy invests in great businesses. It targets large and mid-cap U.S. stocks with the best profitability, strongest balance sheets, and most consistent earnings growth relative to their sector peers. This sector-relative approach to stock selection leads to cleaner comparisons, but it can also cause the fund to own stocks with lower absolute quality characteristics than it otherwise would. To further mitigate unintended sector bets that might otherwise creep into the portfolio, the fund matches its sector weightings to those of the broad market. Now, these adjustments effectively reduce its exposure to technology stocks and increases its exposure to energy and utility stocks. The portfolio favors stocks with durable competitive advantages like Starbucks, 3M, and Facebook. These stocks often carry above average valuations, which tends to give the fund a bit of a growth tilt. Now, this strategy has tended to hold up a little bit better during market downturns than most, but it has lagged a little bit during strong market rallies. Still, since its inception in July of 2013 through the end of January of 2019, it beat the MSCI USA index by 25 basis points annually. Its low 15 basis point expense ratio and focus on strong businesses give it a good chance to continue offering a favorable risk-reward profile over the long term.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.